In this video we're discussing capital allocation. Now this is the process by which capital decisions or capital investment decisions are actually made. And in a moment we'll talk about something very theoretical, namely the steps involved in making an investment decision, spending money or devoting money to a capital investment project, and then we'll talk about the NPV and IRR measures. Now it's important that you should have already watched the previous video on the playlist, the one where we actually do computations of NPV and IRR, including the steps involved in doing so on the Texas Instruments calculator, because we will kind of be referencing those computations. Now, if you already know how to compute NPV and IRR, and many of you will do that from your sort of business/finance education background, that's fine. Let's just proceed with this video. So let's start with a bit of theory. The process that we're talking about here, or the steps involved in it, right? The steps involved are, now, don't try to learn this, it's so obvious, you shouldn't need to. First of all, the idea generation step. So of course, in order to evaluate projects and decide what to invest into, we have to have some ideas, investment ideas. Okay, good, nice and obvious. Now, the next step is to do the actual investment analysis. The investment analysis step is all about doing the stuff that allows us to make computations, and it actually involves computations. So typically what you'll do is kind of in Excel or Microsoft Excel or some other tool like your calculator, you'll be inputting projections of cash flows, projecting cash flows, outlays, how much will the project cost to undertake, what benefits, cash flow benefits will it bring, what size will those benefits be or those cash flows be, including the outlay, but also their timing is extremely important, right, when you work with time value of money. And then, of course, on the basis of that, we will be computing things like NPV, IRR. That's what we did in the previous video, and that's what we'll theoretically discuss now. But also, your book talks about the return on investment capital, which is a measure I'll be exploring with you in the next video. Now, step number 3 is planning. Obviously, planning for the sort of undertaking of the selected projects and prioritization of them. Prioritization, which projects should be undertaken first. It's not necessarily the one with the biggest rate of return or the biggest NPV, because there might be some business logic to doing the steps in a certain sequence. And then step number 4, which kind of happens once the project has been undertaken, is monitoring and post-investment review. Why do we monitor the project? We want to validate the assumptions that were made over here. We projected some cash flows, meaning we built up expectations of cash flows. Did we get that right? What did we get wrong? I mean, did we underestimate or overestimate the cash flows that finally turned out to be the case? Maybe there's some bias, consistent flaw in our thinking that we can now correct using this fresh data. And anyway, this monitoring also helps us or disciplines the parties involved so that they strive for those previously assumed forecasts to actually be met. Right, now for us, as I said, the most important bit of this video are the actual measures. So over here in the investment analysis step, that was step number 2, we mentioned NPV, IRR and return on investment capital, and we're going to take them one by one, starting with NPV. then IRR, and finishing with return on investment capital in the next video. Net present value, NPV. This, as many of you will appreciate, is simply the PV, the present value of all the expected future cash flows associated with the project, be they positive or negative, but minus the typically initial cash flow, which is going to be an initial outflow. Now, in most investment projects, you have CF0, that's what you input on your calculator, being a negative, whereas CF1, CF2, etc. being positives. So, if you depict this on a timeline, you typically here at time 0 have an outflow followed by inflows of various sizes, but these are going to be positive. So that's your CF1, your CF2, CF3, CF4, and so on. And of course, this is what we did in the previous video. We kind of did this by hand, so to speak. Did the discounting, and we entered this stuff into the calculator, but the idea is all those future cash flows need to be discounted. So we need to compute the PV of that first cash flow, the PV of that second cash flow, the PV of that third cash flow, the PV of that fourth one, and whatever else. And ultimately, when we add up all these present values and the initial outlay, which happened at time 0, so it doesn't require any discounting at all, we get a sum. Sorry, that's not how you spell sum. Okay, and that is basically your NPV, net present value. The discounting is done using a rate, which we typically write down as R, and that is your required rate of return. Often this is the company's weighted average of cost of capital. So we require projects to generate a rate of return that at least covers the cost at which they are being financed. Right, that's a logical assumption, but in this section of the curriculum, they just want you to know that this is the rate of required rate of return. Now, very importantly, NPV is realistically a measure of value added. So if the NPV computation yields something that is equal to or above 0, you should ultimately probably accept that kind of project. Why? Because if NPV is positive, it increases company value, it increases shareholder wealth, it increases wealth because it's generating value added. Or if it's above 0, if it's equal to 0, it does not destroy wealth. And it's not that the project isn't profitable, it is. If NPV is indeed equal to 0, it means that project generates a return which equals the required rate of return. Okay, project generates a return equal to the required rate of return, which is absolutely fine. It doesn't generate any more, but it generates what's required. So it kind of touches the hurdle, so to speak, right? But with NPV equal to 0, watch out, there is no room for error, in the sense that if any of your assumptions are wrong concerning the timing and value of cash flows, and they in reality prove to be somewhat less favorable, it will lead to a situation where probably NPV will start becoming negative. On the other hand, if the NPV computation yields from the start something negative, you shouldn't accept the project, so do not accept that kind of project, as it ends up destroying company wealth and shareholder wealth. So project destroys wealth. Okay, it doesn't meet the what's required from such projects. It doesn't, get to the level of profitability or return as set by the required rate of return R. Now, this accepting projects whose NPV is above or equal to 0 is the sort of primary financial criterion which we use in investment analysis. However, it's not the only one. So when you get to this step 2, it's important to note that we as analysts, we do the computations, but there are other considerations as well which may be taken into account. So a project may seem profitable on an NPV basis, however, it may still not be accepted because it doesn't provide too good a fit with other projects that the company is already pursuing, or it maybe has some side effects, or it may be unpopular among society, the other stakeholders than just the shareholders. So whilst NPV is for us the primary financial criterion, it is by no means the only criterion that we use that companies use in making investment decisions. There are others which are sort of less financial, more intangible, so to speak. Okay, let's move on to the second measure, the IRR. Now, IRR, as you will probably know, stands for the internal rate of return. Internal meaning, I'm very hesitant to use this word, and don't quote me on this, but this is like the true rate of return on the project. NPV, by virtue of being positive or not, shows you whether the project's profitability or rate of return is above or below what's required from it. IRR tells you what that rate of return of the project itself actually is, irrespective of the hurdle which you wanted to cross. So this is going to be the discount rate which makes the NPV of the cash flows, obviously minus that initial CF0, the initial cash outlay, equal to 0. In other words, how high do we need to get this discount rate in order for all of these cash flows, the present values of them, including typically the big outlay at the very beginning, to produce a sum of 0. Okay. Now, if the IRR of the project, its true internal rate of return, is higher than R, what we would require from a project, so this R is the required rate of return, the same one that we had on the previous page. And think of that as your kind of hurdle rate, what your project needs to deliver to get funding. If its IRR is its internal rate of return, and by the way, this will be measured in percentages, whereas NPV is always sort of measured in dollars, euros, some currency, monetary units, or whatever other currency. If IRR is higher than R, it means that project is more profitable than what is required from it. That also automatically means that its NPV is going to be higher than or equal to 0, and obviously that means we should invest. So there is very much a link between IRR and NPV. When one is above R, the other should be positive. On the other hand, if you've got IRR that is less than the required rate of return, and simultaneously your NPV will be lower than 0, and you know what to do then. Do not invest. Okay. It's also important to stress at this moment, so if you watch some of the other videos on the channel from the other topics, we often do computations which are synonymous with IRR, and I often say, hey, this is the same as internal rate of return, although they've got other names. So things like the money-weighted rate of return when we do sort of fund manager analysis, or the yield to maturity in fixed income. That's also another name for what essentially is the IRR. And often, especially with yield to maturity within fixed income, I keep repeating that the IRR is only realized. So an investor can only boast that they've really realized a return equal to the IRR or the yield to maturity if any interim cash flows generated on the project are reinvested at a rate equal to the IRR. So what I've written down here basically means that if you've got a project with cash flows like these, right? If you took each one of these interim cash flows, interim meaning happening before the project beginning and the project end, although that final one is actually the project end, so let's not count it. Over the 1, 2, 3, 4-year horizon, you'll only generate an annualized rate of return equal to the IRR if you can take each one of these projects and reinvest them until the project end, which over here happens at the end of year 4, at a rate equal to the IRR, which often is going to be unrealistic. Sometimes, a certain project has a very high rate of return, but you don't really realistically have an opportunity to put that money into a further project that will generate as much return as this one. So, because this is often unrealistic, actual realized returns may be lower than the IRR than suggested by IRR. It's only with projects that generate virtually no interim cash flows until their end date, so something like a zero coupon bond within fixed income, that do not suffer from this risk, this so-called reinvestment risk, and this is explored a lot more within fixed income. Now, NPV so this is important, right? Because it can be easily turned into a nice sort of theoretical question, and you should know that the NPV doesn't suffer from the same sort of unrealistic assumption. There is an assumption built in, but it's not as problematic. NPV, on the other hand, assumes that any interim cash flows are, if reinvested at a rate equal to R, the required rate of return, and that is typically more realistic than the assumption that I gave you above for IRR. So as you can see, NPV is not sort of prone to the same over-optimism as IRR is. Right, a few more technical notes. Sometimes you'll have a project which, yes, at the very beginning may have a big cash outlay, followed, let's say, by some cash inflows, and then maybe a bit more money has to be put in, and then some positives, and maybe, you have to spend money at the end to, remove the what's left of the project, recultivate the land on which the project stood, if it was some kind of item of property. Now, what I'm showing you here is a situation which where the cash flows of the project change sign multiple times. So you go from negative to positive, then from positive to negative, then from negative to positive again. So this is positive, then from positive to negative again. And there are 1, 2, 3, 4 times when the cash flow sign changes with our classic project. So one pattern, one initial outflow followed by multiple inflows. There is only one change of sign over here. And these type of more complex patterns are problematic because if the project's cash flows change sign more than once is okay, but more than once, what you'll get is a problem called multiple IRR, meaning your calculator may, or your Excel or whatever you may be using, may return multiple versions of IRR, and each one will be different. And that's a cue to rely solely on NPV. Don't trust IRR. You don't know if that's what it really is. And the final sort of technical point is, if you have mutually exclusive projects, so projects which cannot be undertaken together, you have to decide which one to basically go ahead with. Always choose the project with the highest positive NPV, i.e. let NPV be the deciding criterion, not necessarily the IRR. But make sure you choose the highest positive NPV project. Don't choose the project with the highest NPV when all the NPVs are negative. That means you will be destroying value. Now, when I took the exam, well, we were sort of always aware of the examiner perhaps trying to trick us that way. You know, no, it's not the highest NPV, but highest positive NPV. That's why it's stuck in my head. I don't think the examiner is that sort of is trying to fool you so much that in this respect. So imagine we've got project A and project B. The NPV of project A is higher than the NPV of project B, meaning project A generates more value added, but the IRR's situation is different. The IRR for project B is actually higher than the IRR for project A. And the case is, well, what should you choose? Well, go with the project that has the highest NPV. Now, why could this conflicting situation come about? What could this result from? The easiest and most typical situation here, or the setups, is that you may have project A being bigger than project B, in terms of its size being bigger. And although B itself is more profitable in terms of generating a return on the capital invested, an IRR, A is still generating more value because, it's, for example, twice as big. And if they are mutually exclusive, then go with the one that can generate more value than the one that is a tiny project, which is more profitable, because in the end, you're kind of, as an analyst or a corporate executive, you want to increase company value and shareholder wealth as much as possible. Obviously, the exception to the rule would be if you can do B multiple times. If B is highly profitable or has a very high rate of return, IRR, and you can do it side by side and replicate it several times, yes, then turn it into a mega project and it will be better than A in terms of NPV as well. But if you can only do B once or A once, go with A because it will generate more value added. That's the rule, ladies and gentlemen. Of course, if the projects are not mutually exclusive, which means you could potentially do them all at the same time, accept all investments, all projects with NPV which is higher than 0 or equal to 0, in the sense that if it's equal to 0, it's still generating a return equal to the required rate of return.